Today, we are going to do financial planning. This is the fifth part of financial management. Now, what are we going to learn in this? We will understand the concept of financial planning, what are its objectives and importance. Now, before I explain what financial planning is, let us understand this example. Suppose you want to make a house for 50 lakhs and it's going to take 3 years to make the house. Now, there are three possibilities. Either the cost will go up to 60 lakhs, maybe the cost of raw material, labor, etc. goes up during 3 years. So you'll run shortage of cash by 10 lakhs. Second possibility is that your house gets constructed in exactly 50 lakhs that you had thought. But this possibility is only 1/3. And there's yet another possibility that you overestimated the amount to be spent and actually the house got constructed in 40 lakhs. But since you'd already arranged for 50 lakhs, so you end up using that also. So maybe you'll go in for a modular kitchen or texturing or something like that. Now, the same example we can use for financial planning. Financial planning, as you know, is in terms of finance, and planning is always for the future. So let us say if the finance manager has to decide about a project to be launched in future, and it's going to take 3 years for the project to be launched, then there are three possibilities. Either the cost of the project goes up, in which he'll have to arrange finance at a short notice, or the project may get completed in the amount that he had estimated, or maybe he had overestimated and the project could be completed in much less. So let us study what financial planning is. Financial planning is called the blueprint of the organization's future. Remember, blueprint means the plans to be drawn much before the work is done. So planning is about the future, but it is done today. So therefore, financial planning is called the blueprint. Then the main role of financial planning is that they ensure enough funds are available at the right time. And not just the funds, the quantum and the timing. So I'll go back to the previous slide. Yes. So in the first case, there was shortage of funds. So even before the project is launched, the finance manager has to decide, in case he runs short of funds, how is he going to manage it? Yes. So quantum and timing. Please remember this. Quantum and timing is always for financial management. Now let us come to the objectives of financial planning. From that example that I had given you earlier, we get the objectives. There are twin objectives. First is ensure availability of funds, and second is the firm does not raise funds unnecessarily. So availability of funds would be required in case of shortage of funds, and the firm does not raise funds unnecessarily means the funds should not be idle. Because if the firm raises funds unnecessarily, then they'll unnecessarily pay extra interest. And if they pay extra interest, that will lead to less profit. Now here I would like to bring to your notice the difference between financial planning and financial management. Occasionally children feel that financial planning and financial management seem to be the same, but they're not the same. So financial planning is part of financial management, therefore it may look very similar. Now, what is financial management? It means optimum procurement and usage of funds. Optimum. How are you going to raise the funds? Like 50 lakhs was the funds to be raised. Now, how are they going to be raised? What is the optimum source of raising that? Debt or equity, whichever. And in financial planning, we are concerned with the availability and the right timing. In case you run short, how are you going to make the funds available at the right time? Then the objective of financial management, because that's a bigger, wider term, is to increase the shareholders' funds. Shareholders' wealth is the objective of financial management, whereas the objective of financial planning is to make the availability of funds. In case you run short, at a short notice, the funds should be available. Then, of course, financial management, the scope is wider, and whereas financial planning is narrower because it's a part of financial management. And in financial management, the focus is on cost and benefit. Remember, optimum procurement, that means you should get it from those sources where it's going to work out the best for the organization. And in financial planning, we are focusing on the quantum and the timing. Please remember this word quantum and the timing. I'm going through this again and again. Quantum and timing. Now come to the importance of financial planning. First, it helps in forecasting. Now, planning is always about the future, and future is uncertain. Anything can happen. So therefore, the finance manager prepares the blueprint. Remember, he was supposed to prepare the blueprint of the future. So let us say that he's expecting the growth to be 20%. But then he thinks that maybe if it's not 20%, it could be 30% or it could be 10%. So he prepares himself for both these eventualities. If it is 20%, no problem, because this is what he expected. Suppose it is less, then he has a plan B for that. And suppose it is 30%, then he has another plan for that. So therefore, financial planning helps the finance manager in forecasting, because now he's prepared for all the three eventualities. And from this point only comes the next importance, that is, helps in avoiding business shocks. Now, since the finance manager is prepared for all the three outcomes by preparing a blueprint for the future, therefore he is able to absorb shock. Suppose he had prepared only 20%, he was expecting 20%. So he thought maybe it can be 22% or 18%, and he did not keep much of variation. Then suppose the return was only 10%, then he would have been in trouble, he would be in for a shock. But now he's considering all the three possibilities of the return being high, quite high, or the return being quite low. So therefore, whatever shock the business has in store for him in the future, he is better prepared for that. Then comes coordination. Now, through finance only, all the functions have to be coordinated. So it is the duty and importance of the finance management that they have to see that each department has got clear policies and procedures, and the finance department only sees that every department has got enough finance. For example, the marketing department needs finance, the production department needs finance, the purchase department needs finance. So he has to coordinate all of them and see that whatever the requirements are being met, so that the organization goes on smoothly. Then financial planning reduces wastage. So when you plan properly for the future, you definitely reduce wastage. Let me give you an offhand example. Suppose you have a pocket money of 500 rupees. Your father has given you 500 rupees per month. Now you plan it in such a way that it lasts the entire month, so you do not waste anything. There's no duplication, and whatever you're spending, you write it down properly so that your money lasts the entire month. Same with planning also. What you were actually doing was planning. So when you plan properly, there's no wastage, there's no duplication. So this again becomes a very good point in importance of financial planning. Then financial planning links the present with the future. Now, what is financial planning? Financial planning is making plans for the future, that is forecasting. And these plans for the future are made today. So in that way, financial planning actually links today with the future. It links the present with the future, because what is being decided about the future is being decided today. So financial planning is the gap between where we are and where we want to go. Then financial planning also links the investment and the financing decision, and this is very important. Now, what is financing decision? Financing decision is where we want to invest, and financing decision is where are these long-term funds going to come from. If we have to make investment, then where are these funds going to come? So financial planning is again about the future. So financial planning helps in linking where to invest with where the funds are going to come from, so that a decision can be taken. That is why they say that financial planning links the investment and the financing decision. And then evaluation of actual performance becomes much better if you plan properly. Now, what is planning? Planning, the first step in planning is setting standards. Similarly, in financial planning also, we set the standards against which we can compare our performance. So it will be easier for you to measure the performance if you know what is the standard. For example, a company, they engaged a worker to do some work. So they told him, okay, you go and start working on that machine. He was not told how many units he is to make. So he started making. End of the day, the supervisor came and said, you made only 6 units. You were supposed to make 10 units. See, everybody around you has made 10 units. Why did you make 6 units? He said, I was not told. If you told me I had to make 10 units, I would have made it. You just told me to go and start working. So if standards are not set, you don't tell him what is expected How will you measure his performance? Then the supervisor couldn't tell him that you made less because he was not told the standard. Therefore, if you want to measure the performance, then standards should always be set. Similarly with financial planning also. So financial planning makes it easier to evaluate performance. Now let's do the case study. I hope you have understood the lecture properly. And now with that understanding, we're going to do the case study. And I told you earlier also, we will first see the question that has been asked, and then from that viewpoint, we will read the case study so that we are able to understand. So here they say, identify the financial concept discussed in the above para. A financial concept could be anything. Also state the objectives to be achieved by the use of this financial. So what are going to be the objectives also we have to say. So Somnath Limited is engaged in the business of export of garments. In the past, the performance of the company has been up to the expectations. In line with the latest technology, the company decided to upgrade its machinery. For this, the finance manager estimated the amount of funds required and the timing. It should ring a bell. This will help the company in linking the investment and financing decision. Dalmia therefore began with the preparation of the sales forecast for the next 4 years. He also collected the relevant data about the profit estimates in the coming years. By doing this, he wanted to be sure about the availability of funds from the internal source of the business. For the remaining funds, he is trying to find an alternate source from outside. So now you have to identify the financial concept and give its objectives. So I'll give you a moment to recollect and then we'll go on to the answer. Okay, now I'll share the answer with you. Yes, estimate the amount of funds required and the timing. So that is nothing but financial planning. So the concept discussed here is financial planning, and the objectives are to ensure availability of funds whenever required and to see that the firm does not raise the funds unnecessarily. So basically, financial management and financial planning only have these objectives. So since the lines quoted were taken from NCERT and they were hinting at financial planning, therefore the answer is financial planning. So thank you, children. That's in this video. Thank you.